Hey everyone, welcome back to the channel where we help business owners navigate the complex world of taxes and finance. Today, we're diving into a critical topic: how to shut down your S corporation the right way. Whether you're ready to retire, pivot to a new business, or simply move on, shutting down an S corporation involves several important tax considerations. So, let's break it down step by step. There are two main ways to shut down your S corporation. You can either sell your stock or you can sell the company's assets and then liquidate the corporation. Each option comes with its own set of tax implications, so let's explore both scenarios in detail. Scenario 1: selling your stock. This is often the simplest way to shut down your S corporation. When you sell your stock, any gain you realize is treated as a capital gain. If you've held the stock for more than a year, it's considered a long-term capital gain, which is taxed at a maximum rate of 20%, depending on your income level. For 2024, if you're a single filer, that 20% rate kicks in when your taxable income exceeds $518,900. For married couples filing jointly, it's $583,750. And for heads of household, the threshold is $551,350. If you're a passive investor, you might also owe the 3.8% net investment income tax, but active participants in the business are exempt from this. Scenario 2: the asset sale and liquidation. This is more common when shutting down an S corporation. Here's how it works: the corporation sells all of its assets, pays off any liabilities, and then distributes the remaining cash to the shareholders. For tax purposes, this process has two main phases. First, the asset sale. Your S corporation will recognize gains or losses from the sale of its assets, and because it's a pass-through entity, these gains and losses are passed through to you, the shareholder, and reported on your personal tax return. Most of these gains will be taxed as long-term capital gains if the assets were held for more than a year. However, any gains attributable to first-year depreciation deductions might be taxed as ordinary income, which could be as high as 37%. Next is the liquidation phase. After selling the assets and paying off debts, the corporation distributes the remaining cash to you in exchange for your shares. If the cash you receive is more than the tax basis of your shares, you'll have a capital gain. If it's less, you'll have a capital loss. And if everything balances out, you might not owe any additional taxes from the liquidation itself. Now, let's talk about some tax-saving strategies. When selling assets, how you allocate the sale price to specific assets can make a big difference. You generally want to allocate more of the sale price to assets that generate lower taxed capital gains, like land and buildings, and less to those that generate higher taxed ordinary income, like inventory and equipment. One more thing: if you enter into a non-compete agreement as part of the asset sale, the payments you receive will be taxed as ordinary income. The good news is that these payments aren't subject to self-employment tax, but they are taxable, so make sure to account for that. Lastly, when shutting down your S corporation, make sure to file the necessary tax forms. You'll need to report the asset sale and allocation on IRS Form 8594 and file the final federal income tax return using Form 1120-S. This includes a final Schedule K-1 for each shareholder. Shutting down an S corporation isn't just about closing the doors, it's about navigating the tax implications and ensuring you're compliant with all the rules. I hope this video has clarified the process for you. If you found it helpful, please give it a thumbs up, share it with your network, and subscribe to our channel for more business and tax tips. If you have any questions, drop them in the comments below, and I'll be happy to help. Thanks for watching, and see you next time.